unemployment's going to be inching higher at 4.3%. Look at that body in motion. It hasn't even changed yet. And expect a mild recession. I just still love that mild recession. Now, obviously, those of us who've been expecting recessions have been wrong completely, but I fully expect just a normal historical recession, reciprocal to the amount of liquidity we pumped and dumped from the system. And also a key thing that's really changing is there's been a lot of extra liquidity from people not having to make their student loan payments. That's off. We've had some major government programs. Those are going to be not ending, but curtailed soon as we get to election season. But for me, the bottom line is, yes, maybe we'll get lucky and get that announcement that BlackRock will get that crypto, that Bitcoin ETF. And then, of course, all the other people like the Winklevoss twins and everybody's been complaining for 10 years will get kind of upset, but we'll go back there. But that's the key thing. That's an if statement.
The year 2022 proved to be challenging for most investors due to the Federal Reserve's rapid tightening of monetary policy. Despite the stimulatory fiscal deficits in 2020 and 2021, fiscal tightening brought levels back to those seen in 2019 as a percentage of GDP. The S&P 500 experienced declines, while bond prices fell rapidly, making it one of the worst years in recent history for a combined stock and bond portfolio. By late Q3 2022, the U.S. Treasury market faced liquidity issues, and the UK's sovereign bond market required intervention from the Bank of England. However, some changes started to occur in Q4 2022. The U.S. Treasury injected liquidity back into the market, offsetting the Federal Reserve's quantitative tightening, leading to a decline in the dollar index. The S&P 500 found a bottom and began stabilizing, and liquidity in sovereign bond markets started to ease. Assets driven by liquidity, such as Bitcoin, started to rebound. As we move into 2023, there are indications that the interest rate aspect of the Federal Reserve's tighter monetary policy may have completed its cycle. Its ongoing inflationary effects on the fiscal side are now competing with the disinflationary effects on the private sector. Homeowners and large corporations with fixed rates may face challenges as further rate hikes increase the Treasury's average interest expense, leading to more fiscal deficits entering the economy. Paradoxically, this can have a stimulatory effect to some extent. As a result, there has been persistent inflation and a delayed recession. In a video, macroeconomist Mike McGlone shares his macro outlook on the economy, discussing why the recession appears to be postponed but cannot be avoided.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
The market went up. Did it go up? Or you expect it to go up because it went up? That's what I love. My favorite technical analysis. I remember dealing that with customers a lot. So it broke through resistance. It's going to go higher. The key reason I think it might have gone up, most markets went up, is because it went down. That is the main reason the crude oil market went down. And that's the main reason I think it's going to keep going down. But here's the issue is we are trying to predict with most of us maybe have in front of me the terminal. I have minimum standard 50 years of data, trying to predict the aftermath of 100 years events with 50 years data. So last few weekends, I went back to analyze most of the crises over history. Main ones in this country is the panic of 1907 and then 1930. I didn't say 29, I said 1930 because I compare this year to 1930. Stock market went up 50% from the bottom and the rest is history. So for me, the bottom line is we are still in the midst of the Fed tightening. So if you look at Fed rate hike expectations, they're still probably not going to peak until let me just pull that up, until 5.4% in November, and right now the 5.08, the effective rate. So there's still a lot more hikes in the system. And the key thing that I like to ask is, we have such a lagging, the Fed watches such lagging measures of inflation, personal consumption, expenditures, employment costs indexes. They've been stuck at 4 to 5% ever. But you look at the trajectory, they're starting to head lower. Fed funds still heading higher. So you have to expect all the lessons of liquidity not to matter for us not to have a recession and for us not to have a decent correction in the stock market. So now let's tilt that over to cryptos. I like to point out the fastest horse in the race, cryptos, have had an okay quarter. They went up about the same. The Bloomberg Galaxy Crypto Index went up more than the NASDAQ. It should, because it trades at basically a much higher volatility, but it's showing divergent weakness. And we're all getting bullish Bitcoin because we're supposed to get that ETF in the US. That's still an if statement. So I look at it going towards, let's say, by the next 6 months. First, so I hope you're right. I firmly hope you're right that we're going to get this continued. Oh, we're not going to have a recession. Everything's fine. Fed can keep tightening. And the biggest pump in liquidity that's dumping is not going to matter. To me, it's the delayed reaction. Then the numbers I'm seeing are specific. And this is one thing I did expect is the market to get all excited because inflation's dropping rapidly. But that's what happens in depressions and recessions. So right now, the producer price index is negative. The finished goods index, it's a year-over-year index. It's dropping at the fastest pace in history. Yes, my data only goes back to 1948. It was really hard for me to compare how fast that dropped in 1930. But to me, that's the macro I'm pointing out. And I'm really happy to be considered wrong by the end of this year for being McGlone by pointing out these facts. And then we have to be, I'll end with this, we have to be very careful pointing out that market's going to go up because it went up. Now we're at the stage it might go down because it went up. Now I get AI. I mean, remember, I was trading when we had the internet bubble. I was trading when we had all those fuel cell stocks. I remember they're great. But the key thing for the second half of this year is the way I look at cryptos, narrow down those cryptos. If we don't get a higher plateau from the stock market, that to me is the domino factor that's extremely negative for everything. Meaning the Fed will have tightened, those tightenings that have kicked in are still priced in and will be in for a while. They're not going to be easing like they have in the past. It'll start tilting lower and then there'll be nothing to save us. Like you've probably been trading for 20 years or so, I'm guessing, and single time the market went down, the Fed saved you. That's changed. So I'll pass it back to you. And again, I do hope, I hope you win this debate today. To me, it's really what happens to markets by the end of this year. And this is the most concerned I've ever been in my 35 years of being in the business about what can happen. And I compare it to 1930.
So massive bull trap, basically.
I think so. Yep. And bottom line is don't fight the Fed. The Fed's still tightening. Got another 30 basis points still priced in the market, and they're going to keep doing it. I think they're at the mode now. They're going to keep tightening until the market tells them not to, the stock market.
On Monday, a significant segment of the U.S. Treasury yield curve reached its most inverted level in decades. This development occurred as traders factored in expectations of further tightening of Federal Reserve policies. The yield on the 2-year note surpassed the 10-year rate by as much as 110.8 basis points, with the shorter maturity rate reaching 4.96%. The inversion reached a level of 110.9 basis points in March, a point not seen since the early 1980s, according to Bloomberg's compiled data. For more insights into this matter, let's turn to Mike McGlone.
Thing about predicting something that's really never happened in everybody's lifetimes is you have to take that risk of going through these little nuances. And I think we're in that. And I'm willing to take that risk that, yes, this is a very unusual thing for someone like me in my position to point out, but I see it every day. I see all these indications. I mean, then we have to ask ourselves, why did the smartest people in Wall Street completely miss the collapse in commodities this year? Because they're missing what's happening geopolitically in China. China's tilting over to me the similar. I mean, some of us saw the Soviet Union collapse and Japan collapse. I was trading equities in the 90s when that happened. These things are macro 100-year cycles that are kicking in the way I see it. And the U.S., I published this morning, the Dow Jones Industrial Index divided by GDP at the end of 21, right before the Fed started tightening in 22, versus GDP was the highest since 1937. So yeah, equities were expensive and still are historically versus everything. And to me, this is that great reset that hasn't even started. But the key thing was the leader of all this were cryptos, 25,000 of them. And the point that they're bouncing, but we see what's happening. There's only one that's a star on an if statement. And the rest are like, yeah, there's 25,000 of them. I'm long from way here, and I'm hoping someone will save me. And the Fed's not going to do that. We're at a stage now that's something that's really never happened in modern history, normal history. Is I look at it, you're sitting at the Fed and you read all their statements and read what they say is they're worried about core PC, personal consumption expenditure, which is 4.62%. Their target's 2%. And for me, I look at it as there is actually no incentive for them until something breaks, and obviously nothing's really significant broke, the number one thing to break, to make them stop tightening. I didn't say ease yet. There's no reason for them to ease. Everything's perfect. Inflation's going down for them. Economy's fully employed. Why take the risk of tilting of what I think they're going to go back in history of being what Irving Fisher said. Irving Fisher, the famous economist, said we've reached a new higher plateau in 1929. That's going to think what's happening. So this is how historic it is. But the key thing I want to point out is what did you fully expect? Some of us fully expect in this environment is people to say, oh, inflation is going down, it's great. It's not just going down. The producer PPI core at minus 9/10, next month is going to be much lower, is dropping its fastest pace ever in history since 1948. So why is that? Why did it go up? And that's the key thing I look at. I have a chart in front of me. I'm just looking at personal consumption expenditures. It went up for one reason, because we pumped the most liquidity in the system ever. And now we're taking it away. Just look at money supply. Money supply didn't matter. I remember trading in the pits in the 80s, and we stopped looking at money supply because it didn't matter. But when it goes up the most and it goes down the most, that's what matters. And I just read this book recently. I knew it was facts, but called Booms and Busts. And all the biggest booms and busts in the history have come back on the back of liquidity that goes away. That's what this is. We're still in the liquidity going away, yet the market doesn't believe it. The stock market does. Now, the bond market does. The yield curve does. The commodity market doesn't believe it. It does believe it. Cryptos believe it. And I look at the opportunity here is for next half is that the big money is going to be made not in leveraged long, because we already made tons of money in leveraged long. The opportunity is, I look at it, is structuring positions in these risk assets going back down, because if they do go down, look at the iterations, they have to stay elevated. I look at crude oil. I don't see crude oil going up unless the stock market keeps going up, and if the stock market is down, it's going to crash. What's going to make it go up other than a war?
Oil prices surged on Monday after top exporters Saudi Arabia and Russia announced supply cuts for August. Saudi Arabia extended its voluntary cut of 1 million barrels per day for another month, covering August, according to the state news agency. Earlier, concerns about a slowing global economy and possible U.S. interest rate hikes had prompted prices to dip. In an effort to tighten global crude supplies and boost prices, Russia will also reduce oil exports by 500,000 barrels per day in August. This move represents 1.5% of global supply and brings the total commitment by OPEC plus auto producers to 5.16 million barrels per day. Both Saudi Arabia and Russia are working together to bolster prices, as oil prices had dropped significantly from $113 per barrel a year ago due to economic slowdown worries and ample supplies. Despite the recent dip in prices caused by sluggish demand in China and Europe, investors are showing optimism as the second half of the year begins. They anticipate a tighter oil balance and strong equities, suggesting a possible avoidance of a recession, albeit potentially narrowly. However, concerns persist about further economic slowdowns impacting fuel demand, fueled by U.S. inflation continuing to outpace the central bank's 2% target, raising worries about additional rate hikes, which could further impact oil prices. For more Daily Dose Crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.